Emergency investor warning. NATO goes nuclear on Russia, imposing swift ban on the central bank. Their currency is collapsing. And now Putin has no choice but to go full-blown war. Now, they have announced another round of peace talks this weekend, but it seems that Ukraine is unwilling to essentially agree to no joining of NATO and to back up the weaponry. And that's what it would take to end this war in a split second. But the US is essentially not allowing Ukraine to make that move. That seems to be what's occurring right now. And with Russia now in collapse mode, they have no other option. So again, the Russian currency is collapsing, down 38% in 5 days. Russian stock market has imploded. It's not down 50%, it's down 80%. If next week's peace talks fail, get ready for more chaos. I believe Russia will demolish Ukraine in the next few weeks if peace is not made. And so that's really what we're seeing. Russia's preparing for the long game to starve Ukraine's capital into surrender, and they're surrounding the whole country right now. Russia may soon cut off natural gas to Europe if Europe doesn't cut themselves off from it. And I believe we're going to see Russia begin to use heavier and heavier weaponry to essentially destroy Ukraine. So it's time to protect your wealth. Buy this simple 3 ETF portfolio for huge profits. Today's March 4th, 2022. This is our investor update. Our top selling advisory is up 11% in 2022. And most people are being taken to the slaughterhouse. They didn't see this coming. But Biden's been releasing little hints that this was going to occur for months. And so most investors are getting slaughtered down 10% or more. Now, this same strategy with very small adjustments last year was up 233% total return in 2021, turning every $10,000 into $33,000. Here's our current trade alert recommendation for $10,000. Step 1, buy 82 shares of UVXY. This is our stock crash insurance. More importantly, it's a dollar liquidity insurance. If the world runs out of dollars, this product goes skyrocketing as people go into margin calls. And that could very well be in the works in coming weeks. Now, in March of 2020, this went up 1,100%. So a 10% position in UVXY is all it took to buy and hold through the fiasco and have very little drawdown. Now, so far this year, UVXY is up a stunning 73%. And we're going to need to carefully time when to sell this product and to buy the dip in our favorite asset. Our favorite asset by far is ETHE. It's having some serious pain today. We're seeing a trend. Every time the bond market sells off, about a 48-hour delay, we're seeing pain in Ethereum. Now, the good news is over the last 48 hours, the bond market's been getting a big bid. Yields have been going down. So I'd expect by next week for Ethereum to jump back up. So this could be one of the best times in quite a while to pick up Ethereum at this discounted price. So ETHE is the product we like. Now, if you'd gotten into Ethereum several years ago, you're up 15,000%. We're looking to double or triple your money this year in ETHE. And the key catalyst is going to be a more dovish Fed, yields falling, and oil costs coming down, all of which I think will begin to transpire in less than 30 days. Step 3 is that we got to realize markets can remain irrational longer than you can remain solvent. So the chaos ensuing in energy markets could get worse before it gets better. And the more discounted energy play currently is in natural gas, ticker BOIL. So we're going to have you pick up 93 shares of BOIL. And again, just a few months ago last year, without war, Europe was having an energy crisis, and they had to import US natural gas to save the day. And BOIL went over 90. If this conflict really unravels in the next month, which at this point it seems to be the case, we could be seeing oil go to way over 100, perhaps to the $200 price range. So we're holding on to this until there's a clear de-escalation. Now we know what needs to occur for a de-escalation, but again, doesn't seem like Ukraine or the US is willing to do what Russia wants to immediately end this war. So what is the end goal with all this? Very confusing, especially ahead of midterms with inflation being the Democrats' key problem. They're doing everything possible to drive inflation sky high right now. Here's a look at our asset allocation breakdown currently. We're 16.5% long UVXY. So if the markets crash next week, we are completely protected. Our growth asset getting whacked in the head today, but don't worry, yields are falling. This is a brilliant time to load up on ETHE. It's down significantly today. And then oil, again, that's the big wild card for an energy shock in Europe. It would be Russia's greatest way to really, really tip the scale in their favor as this war progresses into next week. So we'll watch for the peace talks, but so far, all we hear from the US is more and more sanctions. And frankly, the US doesn't even discuss with the American population what Russia wants. So it doesn't seem like they have any intention to de-escalate this in the near term. Now, if a de-escalation is in the cards, expect energy to crash, and this sell-off will cause bond yields to fall. And so again, we are at some pretty extreme levels. I think if this does get worse next week, we're going to see Brent oil go towards 125, maybe as high as 150. And we're going to see natural gas break into new highs. And so I do still think we can make more money with natural gas than oil, because oil's at peak prices. And so we're already starting to see some companies willing to pick up Russian oil at about a $30 per barrel discount. So I think the big money making opportunity, the shock to markets, remains going long natural gas. Here's your TLT. Now again, we can see that the TLT is at a support line. I believe we're going to see yields fall for the remainder of the year, and that we're going to see these energy costs come down to really push that narrative. If that's the case, we really want to be long growth assets during the de-escalation phase of this this war with Russia. So that, I believe, is probably about 30 to 60 days out maximum. And again, falling bond yields are most likely to moonshot cryptocurrencies and technology companies. So we're a big fan of being long the NASDAQ in our safe growth advisory, and then Ethereum in our high risk strategy. And those are our two favorite picks once this de-escalation occurs. So we're heavily hedged with UVXY and oil to protect our growth stocks. Second, we see the signs of a de-escalation, we're going to dump those assets. We're going to short oil with ticker DRIP, and we're going to go big time, even heavier positioning into growth assets. Jam says, can we not follow the trading plan? I wouldn't do that, Jan. As you know, I would follow the trading plan at all times. He was asking if we can only buy ETHE. So other important highlights is China's in a credit expansion phase, and now Europe's going to have to extend QE due to the disruptions of their economy. So look for more money printing, all bullish for cryptocurrencies. Also, I want to point out the last time the US tightened with its central bank as China expanded, Bitcoin returned 4,400%. And why? Well, the main reason why is when the government and the Federal Reserve are in a tightening period, it essentially forces negative returns in bonds. So until the market thinks the tightening cycle's over, bonds are going to be a losing bet over the long course of time. So we're expecting around a 2-year tightening cycle for the US. It'll be nice and slow, and that this is going to be very, very bullish for growth assets. Now, here's the chart from 2016 to 2018 when we did exactly the monetary policy we're about to pull off right now. That's hike interest rates and let the balance sheet run off or sell assets from the central bank and make that balance sheet reduce. So beautiful opportunity until it's not. If you know what happens next in this chart, essentially Bitcoin crashed from 20,000 down to 4,000. And that's because the bond market became very attractive relative to inflation. And then the central bank stopped doing the rate hikes, making bonds a brilliant play. Big picture, global economies are slowing down. We went from printing trillions of dollars during the lockdown, and we can't say the naughty word, otherwise Google will censor us. But there's been no more stimulus for over a year now. So everything's starting to slow down. And really the last chain link that we need to get to fall in cost are energy costs. And again, this is being aggravated by geopolitical tensions currently. Now, this war with Russia could also almost certainly cause food inflation and perhaps civil war and unrest in poor countries. So look for more warmongering in this year coming up. So energy and food are going to be the sticky parts of the inflation picture that we may have to recalibrate for, depending on how long this war with Russia transpires. So we're looking at our opportunities for investment, and cash is trash. We're still spending much more than we make. We're running massive double deficits. We import more than we export, and our government spends more money than it makes. And this is the case for just about every country in the world, outside of Russia and China, funny enough. Meanwhile, bonds are trading at very low yields relative to inflation, and we're headed into a rate hike cycle. So that's not a great place to park cash, probably for about another 2 years. So I'm expecting essentially a big melt up in crypto for the next 2 years. And then we're going to want to go heavy duty in bonds. And again, that's going to be when the inflation's falling and interest rates are catching up to that level. So again, investors really have no other logical option. That's why we stay hedged against volatility and understand there's really just a few assets that make sense in this environment, which are stocks, cryptocurrencies, commodities. Expect those to melt up until bonds become attractive again, or until governments balance their budgets. Okay, and those are just not happening anytime soon. So make sure you watch our webinar every Monday, Wednesday, Friday to be ready for the sell alerts. Okay, so if you're on a free trial, you get the entry, but you're not going to get the exit. You need to take advantage of the 3 special prices deals per day by upgrading and calling Dean at 505-322-7515. Upgrade your free trial, gain access to the membership area, and don't miss our critical sell alerts. Okay, we're going to switch to some data. We'll start off with the headlines. Most important headline is Biden saying he's going to sanction Russian oil. And Janet Yellen saying we're going to do more sanctions if the invasion continues. They're not talking about making terms with what Russia wants in this war immediately. So until we start to get that type of vernacular out of this administration, I think Putin's trapped. He has to attack and attack hard, and most likely will in the coming weeks. Ukraine plans to hold 3rd round of talks with Russian officials this weekend. I expect that to probably do nothing, but we will have hopes. Russia recommends fertilizer makers halt exports. Energy investors should be fearful, not greedy, about $120 plus oil. And he's just saying this will destruct demand and also upset bond markets. So we're getting ready to short oil within the next 30 days. And it's going to probably be our single greatest returning trade of the year. Because I think we're going to see oil fall to about 80 as soon as we have a de-escalation here. So haven't pulled the trigger yet, but we are getting ready for that move in the near term. And again, that would be also when we can sell boil by drip. Lynn Alden points out that Ukraine has raised more than $50 million from cryptocurrency donations. Russia has reportedly blocked or restricted access to Twitter and YouTube. Yellen will act further if Russia furthers Ukraine invasion. Many of the last several recessions were followed by skyrocketing crude oil prices. So again, this needs to come down or it's going to crash the entire global economy. Every day that transpires with it at these elevated levels is very dangerous for markets. Flashback, Bill Gates becomes the largest private owner of farmland last year. Of course, he was investing in Moderna before the lockdowns, and now he invested in food right before we had a food inflation problem. Funny how that works out. Robert Barden says Biden's genius solution to spiking inflation, especially in fuel and food prices, is to impose massive sanctions on major fuel and food suppliers. And meanwhile, he's not opening up the Keystone Project or allowing America to ramp up energy production. So you just really got to wonder what is going on. Biden also has no intention of engaging with direct negotiations with Putin. Rabobank, if wheat prices continue to rise, then a growing chorus will point to the risks of potential rerun of the Arab Spring in the Middle East and parts of Africa. You think we have chaos now? Throw in some new civil wars. Now here's a look at the sentiment indicator. So we're at a very extreme negative sentiment. This is typically a great time to buy stocks. So with that said, again, markets can be irrational longer than you can remain solvent. And we are heavily hedged in case there's another breakdown in markets next week. Russian watchdog says Twitter is getting blocked in Russia. They also cut off YouTube. Pretty much they kicked out the BBC. So they're going into war mode. Meanwhile, we had a big payroll come in at 678,000 jobs. So it's going to put pressure on the bond market. So we got expensive oil and large job gain this week. So with the bond market having a falling yields today, that's simply due to the conflict with Russia currently. I do think we're going to see more pain in bonds once this ends over the course of 24 months. Paradoxically, the structure of the euro-dollar system is such that the closer the system gets to breaking, the higher DXY goes. So Luke's saying this is a big pivotal moment in currencies, and that we're going to be seeing a lot of people go off the dollar, and now we're seeing a big push into trading the yuan with their monetary system. Now, China still represents a tiny fraction of Forex volume, but this is definitely a big, big change that's going to start to splinter the US dollar's dominance, in my opinion. Lance Roberts says odds of a rate hike in 2 weeks continue to fall. And so now it's below 100%, but I would be shocked if we don't get a 25 basis point hike in about 2 weeks at the next FOMC minutes. Russian crypto trading volume has dropped by 51% across exchanges in the last 7 days. Here's a look at the military comparison of US and Russia. So we can see 560 billion for the US, Russia at 60 billion. They do have big ground troops, but again, we're just going to have to see how this plays out. At this point, I think it escalates further. Here's a little update on China. All of this happened in Chinese markets this week. 2 large state-owned banks restrict USD financing for Russian commodities. Chinese lenders have complied with US sanctions against Iran, North Korea in the past because of need to access to the USD clearing system. Chinese-backed development banks halt loans to Russia and Belarus, opting for a cautious approach to their financial support. Chinese buyers scour markets ex-Russia for stuff like oil, gas, iron ore, barley, and corn. We also saw some big banks picking up Russian corporate debt at big discounts. Okay, we'll skip through the rest of that. In general, China is having a economic meeting this weekend and setting goals, and that's expected to be a 5% GDP. So they're going to have to really ramp up credit to pull that off in the short term here. A weakening economy, a property market crisis, Hong Kong's chaotic sickness response, and Russia's invasion of Ukraine. Xi has a lot on his plate ahead of China's National People's Congress, set to convene its annual full session on Saturday. Russia will do what they want, and there's little Ukraine can do to stop the attack without outside support. Russia's army is many multiples the size, and their combat aircraft fleet is the largest in the world outside of the US. Russia is now throwing you in jail if you are anti-war with quote unquote fake news. JP Morgan tally of damage from sanctions on Russia showed the economy's collapse may be comparable to the default of 1998. A crash in Russian GDP of 11% is in line with the drop of the 1998 debt crisis. So we're starting to see money markets get some pain due to this crash in the Russian economy. Also, this reminds me of when we did war reparations against Germany post World War I, and it ended up collapsing the European economy and eventually spiraled into the Great Depression in the US. So the longer this goes on, bad news for markets. There was news that Nord Stream 2 had been filing for insolvency. Apparently that was not true. Live Monitor says of the quoted, now Live Monitor thinks Russia may have to actually retreat here. We will see. Of the quoted 200,000 Russian troops, only 50 to 60,000 are active fighters. The rest are logistical support. Math is 3 logistical support to 1 active fighter. So the stated deaths of 5,000 Russian soldiers is quite devastating. Zelensky of Ukraine will not make any concessions that will embarrass Ukrainians in their fight for territorial integrity. There's hype of a nuclear Chernobyl event last night, which was greatly over-exaggerated. And this nuclear power plant is now being held by the Russians. Putin claims Ukrainian forces took thousands of foreign citizens hostage, including students. Wage pressures didn't jump today, even though we had a large increase in jobs and higher weekly average total hours spent. There's a look at the Russian forces circling around Ukraine. Meanwhile, record amount of money flowing to Russia for the sale of natural gas. So that's why we haven't seen the price skyrocket yet. They're not willing to slow down the purchases. And so far that has still been making us good money, but boy, oh boy, if there's a cutoff of natural gas, we could see those costs skyrocket. Dave Colum, suspect of media, says somebody posted a documentary about Ukrainian politics on YouTube and now it's gone. This is yet another narrative that we are left to untangle. I believe nothing told to me by the mainstream press, nothing. We are on our own now. Ukraine is certainly a very, very corrupt country. It's a huge history of having money unloaded into it in the US and then disappearing by the billions. So it's definitely a proxy US country here. BAML on paper, replacing all of Russia's gas pipeline exports to Europe with fresh LNG imports would more than double Europe's current natural gas imports and require over 25% of global natural gas supplies to be diverted to Europe. So that's what we're betting on with Boyle, is that this type of behavior is going to begin playing out, and it would make those costs skyrocket. Goldman Sachs, JP Morgan, purchasing Russian debt. So these big bankers have a history over the centuries of financing war on both sides, because whoever wins, they still get the payday and remain in a powerful position. Zelensky says, close the sky or give us aircrafts, while speaking with media. Called on NATO to close the sky, which means shutting down Russian planes and, of course, an act of war. So we got Mark Rubio just going ballistic about going to war with Russia, on and on and on. So it's bipartisan at this point. I don't really see almost any politician speaking out against war. The State of the Union was a big sales pitch to go to war. They've been hinting at this for months. So it's definitely been more aggressive than I expected, but we have been well positioned, and our portfolio returns do show that. Okay, some of those claiming we're in World War III have risen to the top by ensuring we would be unable to defend against it once it broke out. They kept us strategically, politically, culturally, and morally weak. ECB to press pause on stimulus exit plan as war impact is weighed. Now, a lot of people are saying Putin's not part of the World Economic Forum, but here he is shaking hands with Claus. All of this is very, very suspicious. What's playing out here? CNN says Joe Biden's message to Putin: the adults are back in charge. So yeah, we just need to be very careful here and see how this plays out. The second there's a peace deal, we know what to do. We're going to dump UVXY, we're going to dump Boyle, we're going to buy DRIP, and we're going to buy ETHE. It's just as simple as that for now. Until then, we just need to stay positioned how we are currently with no changes. Here's a look at the bond market. The 2-year stopped going up, which means perhaps less rate hikes. And Powell's told us that we're going to have a 25 basis point hike, not a 50. I think the bond market will like that, and the stocks will like that. So our favorite play is crypto. Probability for 25 basis point hike is at 94% currently. Big drop in repo. So this is interesting. This went from 1.6 to 1.4. Nothing to be alarming, but this is a signal that we're running out of good collateral for banks to buy in the bond market. Here's a look at Boyle and NRGU going up just about lockstep, depending on how far out we go. We can see what's had a better return. I think the massive money-making opportunity, if things go wrong, remains with Boyle over NRGU or USO. So let me throw up USO just to see how that's done, which is more of a spot oil product. So very similar return in all three. Let's see if USO is outperforming the short term. Not really. So yeah, that Boyle's really, it's slightly underperforming from the 17th. But again, oil's at record prices during this calamity, and natural gas has not broken the high of last year. So I think that's where the big potential gain is for us in the near term. Okay, lumber futures keep going back up. They had warned us of a oil collapse or sell-off last year, and so far they're not warning of that currently as they continue to go higher and higher. Gold is underperforming copper, which indicates we should have rising rates coming in. Baltic Dry Index, the cost to ship commodities between continents, was crashing for several months. Seems to have found a happy price point over here. This was telling us perhaps the inflationary pressures would be slowing down into this year. Here we have interest rates in yellow. And here's what I want you to note. Overall, we've seen these interest rates fall as oil went skyrocketing up. It's because we have this war causing the oil shortage. So we're getting a bid for safety, and we're getting a collapse of supply of oil. So very, very interesting. I believe we're going to see those oil prices crash as soon as we get a de-escalation, and that this should be within 30 to 60 days maximum. And if not, we're going to have bigger problems to worry about. So paying close attention to this and trying to get us the best exit on our hedges. This chart, we're looking at the RSX, the triple T, and US oil costs. So I believe there will be a great trade to buy up Russian energy companies through the RSX ETF, but not yet. So I like DRIP, I like RSX, and I like ETHE as a smart set of trade alerts soon as we get a de-escalation. And again, does not seem we're about to de-escalate. This chart, we're comparing emerging markets to the NASDAQ from December 22nd. And we're just examining whether or not emerging markets could potentially outperform the NASDAQ in the coming year by having less volatility. Now, they had to stomach pulling out 2.5% of the index and all the collateral effects of Russia getting taken out of all these indexes. So that did drop emerging markets significantly from the 14th to current. But once the dust is settled, I do see emerging markets being our best performing stock index as China goes into a very aggressive credit easing cycle and the US begins hiking interest rates. Russell 2000 had a big drop off, but has stabilized, trading flat. The European index, of course, taking some pain, but remember, this is now causing them to want to expand debt and keep rates lower and keep printing money. So the second this de-escalates, expect EFO to really outperform as well. The dollar index hitting 98. This could probably be the main explanation for why cryptocurrencies are relatively cheaper. It's because we're getting a big bid on the dollar. So again, second this de-escalates, I'm expecting essentially for the dollar to fall. And that would make the relative value of cryptocurrencies rise rapidly. Chinese currency is super strong, outperforming the dollar, but again, it's not freely traded. Looking at some volatility. So from the 3rd, we can see some pretty, nothing too alarming, but we can see a 4% sell-off in NVIDIA, 4% in Amazon, 3.7% in Microsoft. So there's not an extreme panic out there. We're just seeing a slow sell-off so far this year. Nothing too crazy yet. Here we're looking at JP Morgan, Bank of America, Berkshire Hathaway. And if we zoom into a similar period, a lot less drawdown than the tech giants. So that rate jump 2 days ago, where the TLT sold off 3.5%, I believe is creating the tech pain, now delayed by 2 days. So that's on, but we're now seeing a delay in tech companies and cryptocurrencies reacting to bond moves. So again, 2 days ago, TLT sold off 3.5%. The next 2 days, it's recouped those losses. So that presumably would be showing up in tech prices next week. We will keep a close eye on that, and cryptocurrencies over the weekend, of course. Now in this chart, we're comparing Taiwan semiconductors from Taiwan to 2 Chinese tech giants, Alibaba and Tencent. And the signal we're looking for to get even more bullish on emerging markets is to see Alibaba and Tencent outperform Taiwan semiconductors. So far, that's just not happening, and now they're underperforming since the 25th of February. Toyota, Japanese company, but part of our European index, now down 19%. So this is one of the strongest stocks over the last 2 years, getting really hit hard over this this crisis here. Meanwhile, Exxon keeps going up. These energy companies don't want to reinvest profits into expanding capacity. So right now, the world's running about 5 million barrels short per day. And that's about exactly how much Russia puts into the market. So yeah, there's no real plans anywhere to increase the supply anytime soon. That's why we got to be patient about shorting oil. Most likely we need a strategic oil release and a de-escalation, and then you're going to get that big shock on oil prices, which I believe will be a buy the dip opportunity in the long term, but it's just really overdone right now. Here's the yield curve, keeps going flatter and flatter. We're about to invert. Somebody asked me when I think we're going to invert. We will see, but at this pace, we could be inverting next month if this problem with, if the oil keeps going higher and the conflict keeps getting worse, then the inflation is going to make that 2-year keep going up, but the expectations of a crashed economy is going to make that long end go down. So yeah, what a chart. Let's take a look at it. Now, typically it's 16 months after the yield curve inversion that you get the stock crash, and it's really the long end rising where the crash plays out. So this is actually a bullish time for our positioning over the next several months if this trend continues. Okay, so here's that move in the bond market I was talking about. So I believe it's this sell-off in the TLT from the second into the third that's creating the tech route today. Okay, so there's just a trend I've been picking up on. It used to happen the same day. Okay, but now we're seeing this delay. And so now bond yields have risen, or excuse me, bond yields have fallen. That means green line's going back up. And so we'd expect, if this is correct, that we see a rebound in cryptocurrencies by Monday, most likely. Here's Ethereum and Tesla trading highly correlated. Just gives you an idea of just how Ethereum's treated as a tech stock, like Tesla. And so we look for any discrepancy in these prices to potentially predict any future price action. And my feeling is that Ethereum is dramatically oversold and ready for a huge bounce to catch up to Tesla here. But again, we need oil costs to go down and inflation expectations to fall. Here's a look at gold with UGL, a leverage product, and AGQ. Gold's whooping silver's butt currently. Big gap there though, so the silver trade might be pretty exciting here. Haven't pulled the trigger on it, but that might be a potential trade alert as well. And so the central bank asset is doing pretty well over 2016 period to current. We had played it in this run up and luckily got out near the top, and the last year's been very boring, but it's starting to look like it's getting ready to really ramp up once again. So that's the supposed stagflation trade alert. Sticky inflation with a crashing economy. Here we're looking at TMF, a leveraged product on treasuries, the long end, against the dollar. And in general, we're seeing these trade quite correlated to one another. In this chart, we're looking at some alternative energy sources to oil. So we're looking at uranium, rare earth metals for lithium, for batteries, and then copper miners. And so all of those are selling off today. If we zoom out a bit, we can see some of the volatility and the relative discount. So rare earth metals trading at about a 30% discount from its recent highs. Uranium trading nearly 50% off from its recent highs. And again, I do believe this will play out very well for us over the next 24 months. And that's part of our safe growth strategy, not the high risk strategy. Now in this chart, we get a feeling for just how out of control interest rates can get. And the last great example where oil was sticky and ended up causing a recession and a housing crash was from 2002 to 2006. So this extreme could get much worse if we do get a real recovery and have high demand for commodities relative to gold. So we need a strong economy for that. Here's our yield curve over the last 3 months. So it's inverted on the 20 and 30 year, which is bizarre. But what we're really worried about as far as a yield curve inversion that would create headlines across media is if the 2-year went above the 10-year. And so it's getting close. This is the closest it's been. Meanwhile, so we got the 2-year going up and we got the long end moving up much less. So this is signaling the Fed's going to have to hike interest rates to kill inflation, but they will also kill the economy. Here's our VIX futures term structure. It's in backwardation. That's what we want if we're going to have a big position in UVXY and hope it's about to jump up in value. Now the catch is if there's a de-escalation, it could fall in value very quickly with this setup as well. So with that said, you want to own UVXY with the rest of the portfolio. You don't want to buy part of the portfolio. You want to buy the entire portfolio as they work together. Here's a look at Bitcoin, Ethereum, and Polygon. We're seeing the most pain since the 17th, and Polygon down 36%, Ethereum down 21%, Bitcoin down 8%. Now, if I zoom out a bit, we can see Polygon is like in a super aggressive tech position. So it has returned since April of 2021 as high as a 680% return, while Ethereum's had up to 160% return, and Bitcoin far less, essentially trading flat over much of this period. Now, Polygon is not part of the high risk portfolio. If you do join Portfolio Builder and become a member, you can learn about our private equity offering, where we do have great exposure to Polygon. So as soon as the oil costs come down, and we probably get a dovish surprise this March, I'd expect Polygon to outperform just about every asset you could possibly get your hands on. So beautiful setup coming here for this asset. Okay, so coming up this month, we have a CPI print. I believe it's going to be below 6.5, and that the bond market will be able to stomach that. And that in March, we're going to peak out at about 7. So I'm moving up my targets a little bit. Before this crisis with Russia causing energy costs and food costs to go up so much, I was thinking it could be more like 6.4 and then 6.8 to peak out. Now, if this conflict continues for months, then the inflation could stay very elevated, way uncomfortable for policymakers and the bond market. We're going to have to recalculate how to position ourselves for a very aggressive Paul Volcker style rate hike cycle. So this energy costs need to come down within the next 30 days, or else I will have to recalculate what the path of the Federal Reserve will be. And to be frank, I believe they will have to hike interest rates aggressively and crash the stock market if that oil cost doesn't come down in less than 30 days. Producer prices index does seem to be topping out, so that's good for our projections in the markets. Here's that non-farm payroll that jumped at 678,000 jobs. We're now only 2 million jobs shy of the record we had before the lockdowns with Trump. So these jobs are coming on board. This is going to put pressure on the bond market once again. Total assets still at $8.9 trillion. Went down on the update yesterday. I thought it would have hit 9 trillion. Next week we should probably hit $9 trillion. ECB's balance sheet keeps growing at $8.6 trillion. And again, with all the chaos in Europe, looks like they're going to keep the printers rolling for much longer. So we got expansion of credit in 2 major powerhouses, Europe and China, while the US tightens. So this could be the perfect setup for crypto, similar to the 2016 to 2018 run-up. Okay, so we're about to switch over to revealing our exact asset allocation for both strategies, safe growth and high risk. If you're on a free trial, you're going to get cut off. You don't get the end of this video, and you're not going to get the sell alerts. So call Dean to upgrade now at 505-322-7515. Take a quick look at any questions. Tony says, do you have a flat fee? Yes, we do have a flat fee. Absolutely. And Kent says, what about gold compared to Ethereum? Yeah, so we're actually seeing an inverse relationship between Bitcoin and gold lately, which has been somewhat interesting. So yeah, I actually look at crypto as a tech company, not a store of value, such as gold. So yeah, if we thought there is a year-long war about to develop, we might want to get bigger in treasuries and the dollar and the VIX. If we think we're about to come to a resolution in the next 30 days, we're on the verge of selling our VIX and we're on the verge of selling our BOIL and then betting on falling yields, falling oil, and a big melt up in the very shorted tech space. Marcus says, why is Polygon so valuable? It makes Ethereum infinitely more valuable. It's like the Lightning Network for Bitcoin. It's got 1/30th the market cap of Ethereum, and it's growing rapidly. So it's a very neat asset. Very few people own it. Mostly just the owners do. So from a decentralized point of view, that's bad. But from a greedy tech standpoint and the ability to manipulate the price higher, it's beautiful. Michael says, is Tether going to crash? There's been fear of Tether crashing for years. So far, nothing's happened. Michael says, is China going to crash? No signs of China is going to crash. Imports, exports at record levels, and they've been popping bubbles on purpose, and they haven't printed any money for the last 2 years. So now that we're slowing down, they're going to expand credit. So I'm actually expecting outperformance in Chinese equities over this coming cycle. I don't know why the reverse repo dropped from 1.6 to 1.4 trillion. Probably has to do with the money markets though, Stephen, and probably related to Russian drain of liquidity. Yep. There's no options trading on ETHE. It's a OTC stock. Energy is 3 times leveraged just by energy. You don't need to get crazy. Assoc says, do you expect any impact on crypto from China policy? No, but we need to worry about Janet Yellen wants to regulate it. Looks like they're just going to target centralized exchanges. They're going to say, hey, if we give you a list of bad cryptocurrency addresses, you have to seize those funds and not allow them to convert. So that's what I'm expecting from that front. Jason Sass says, what's going on with Iran? Looks like they're going to add Iran to OPEC and help supply some oil and take off all the and let them start getting ready to make nuclear weapons again. It's being led by Russia, so what pretty bizarre, but yeah, so that should help fund some terrorists and get oil costs down. Is what I take out of that. Gary says, idiot move. Yeah, everything we've been doing here is all we had to do is agree not to add Ukraine to NATO and back the military off, and there would have been no war. But they wanted war. This seems to be the plan. Michael says, so they will stop crypto fiat off ramps and regulate centralized exchanges. Yeah, it seems like they want to be able to give Coinbase a list of Bitcoin addresses and say those funds cannot flow through your, you have to freeze any Bitcoin that comes through these addresses, which is probably going to drive more money to DeFi, which is where our private equity setup makes money, providing liquidity. If you want to, we're mainly making money for our investors in our private equity fund by allowing people to trade between Polygon and Ethereum. Anytime someone wants to flip between those two pairs, we get a trading fee. And so you could do it at Coinbase, but if for whatever reason you don't want your money at risk of being seized, you go over to Uniswap, and that's where we're doing our, they call it yield farming. Okay, very good, guys. So let's hop into strategy and what we're expecting.